and welcome. This is Professor Swark, and we are going to walk through selected topics from Chapter 5. Before we begin, I just want to remind you that this session is always selected topics, so I recommend that you read through the entire chapter, take notes, seek help if there's something that you don't understand, and make sure that you complete all the coursework as well as just spend some extra time self-quizzing throughout this chapter. So today's objectives are really, we're going to take a break from journal entries and work on how do we actually compute the cost of goods sold or ending inventory. So last week we talked about the journal entries for when we make a sale. We record cost of goods sold and reduce merchandise inventory, but today we're going to actually focus on what goes into those amounts. And we're going to look at that computation 4 different ways: specific identification, FIFO, LIFO, weighted average, and then we're also going to look at it under a perpetual versus a periodic method. The periodic method is an appendix, so make sure that you read that portion of the material as well. So real quick, let's just talk about periodic versus perpetual inventory. So periodic inventory methods, basically a company chooses this method and they always record the purchases of inventory. They always record the sale of inventory, but then they just periodically, that's where the word periodic comes from, they periodically record reduction in inventory. Okay, so this is more your mom and pop or small business. I know that I go to my vitamin store and it's a manually run store. There's no scanners there. When you buy your vitamins, they actually just punch it into kind of an older-fashioned register. Okay, that would be a periodic system. They always record their purchases when they come on board. They always record the sale, but they don't do that second step, that reduction in inventory and recording to cost of goods sold. They only periodically do that, maybe whether it's the end of the week or end of the month or just periodically. Versus a perpetual system is something that's more common today, and that's where we always record the purchases, we always record the sales, and we always record reduction in inventory. And this is electronically. Walmart is the starter of this. When you scan your items through Walmart's checkout line, the inventory is automatically reduced. Okay, and the system is updated. So that's a perpetual system. That is most of the businesses out there today. Most of the corporate businesses out there are perpetual, and it's just the smaller shops that are periodic systems. All right, so we're going to first focus on perpetual systems, and that's the bulk of the chapter. And to demonstrate these systems, I'm just going to go ahead and go through a sample problem where we're buying gallons of milk, buying and selling gallons of milk. So on October 1st, we purchased 5 gallons of milk. Okay, we're clearly a small company. They cost us $1. Okay, so we may be selling these gallons of milk for $3 or whatever the cost may be, but our cost is $1. Okay, on 10/2, so October 2nd, we purchased 5 more gallons, but oh, look at, there's a price increase. Our vendor is now charging us $1.20. Okay, so let's add in those gallons of milk, and then on October 3rd, we purchased 5 more gallons of milk for $1.30. I don't know why we're buying all these gallons of milk when we're not making any sales, but hey, we've got 3 different sets of inventory on hand. Now these are all the same types of gallons of milk. The expiration may be different, but you cannot distinguish. The customer cannot distinguish between this first gallon, the second set of gallons, or third set of gallons. Okay, there are no markings other than the expiration date on these gallons of milk. If I were to put these through a scanner, there would be no different barcodes on any of these 3 types of milk. Okay, on October 3rd, if we sell 1 gallon of milk for $2.99, okay, the question becomes, which gallon of milk got sold? Okay, so here's our cash sale. I'm assuming it's a cash sale, not a sale on receivables, because it's just gallons of milk. So we debit cash, we credit sales. Okay, that's always going to remain the same. The selling price does not change. But what today's chapter really focuses on is which gallon of milk do we record as a sale? Do we record the old one, the middle one, the new one? Do we figure out which gallon of milk the person actually bought? Do we do some sort of average? How do we do that? And really the company decides what policy we're going to use. Okay, there's different types of policies that we can use. So On 10-3, if we sold 1 gallon of milk for $2.99, we don't know which one we're going to record. Okay, under specific identification, we would know exactly what gallon of milk got sold. Okay, under specific identification, only a few companies can actually use this because, like I just said, milk is going to have all the same barcode. It's going to be very expensive if Walmart actually distinguishes each gallon of milk and each cup of, or each can of soup, and so on and so forth. So specific identification is primarily for things like vehicles that are sold. They have a specific vehicle identification number, or high-end jewelry, or other customized products. Okay, under specific identification, we would know exactly which gallon of milk sold. So, oh, it's this one. This milk is $1.30. So here we know that we sold this one specific gallon of milk. It cost us $1.30. Okay, that's specific identification, when we can identify which gallon of milk or which product got sold. Again, this is really hypothetical because this would not be the case for a gallon of milk. Okay. If we do the same scenario again, but we pick FIFO. FIFO stands for first in, first out. So the first gallon we purchased, okay, way back here, the first one we put on the shelf, would be the first gallon out. So first in, first out. Under this system, we could say that this here, over here to the left, is the gallon that we sold. And there we have it. Our cost of goods sold is $1. Okay. Our ending inventory then would consist of all the remaining gallons of milk. Now, this system does not actually mean that this customer, we would stand at the counter and say, oh, customer, we use a FIFO method, so you have to take this gallon of milk, right? Because the last time I went to the grocery store, I had the freedom to choose my gallon of milk. Okay, but this is just a system that we follow because we have to figure out some way, how do we cost out our inventory? So all of these gallons of milk are the same. This is just a system that we choose. This is a policy we choose. So it doesn't really matter which gallon of milk got sold. All right, under the next system, which is LIFO, LIFO stands for last in, first out. Okay, so the last item that we shelved, okay, which would mean this last one that we stocked on the shelf, would be our first item sold. Okay, and again, this is theory because the customer is free to choose whatever gallon of milk they want. But under this process, we're going to just assume that the cost of the inventory out, okay, last in is the first item out. So in this case, the $1.30 would be our cost of goods sold in merchandise inventory. Okay, and then the last method we're going to look at is weighted average. And under weighted average, we take an average of the three. However, you have to be careful. What you want to do, since it's a weighted average, we multiply out each tier of inventory. So 5 gallons of milk at $1, 5 gallons of milk at $1.20, and 5 gallons of milk at $1.30. Okay, then you want to take the total dollars by the total gallons of milk to get your weighted average. Okay, a weighted means that, let's say we had only 1 gallon of milk in this middle tier. The other two are going to have a heavier weight. Okay, or if we had 25 gallons of the heavier, the $1.30, okay, the $1.30 would have a heavier weight. So that's simple enough to do. You just multiply your product times the product price, you add it all up, total dollars over total units. Okay, in this case, 1 gallon of milk would be $1.17. The remaining, 14 gallons of milk would be costed at also $1.17. All right, so we're going to go ahead and go work through some problems here where we determine not only cost of goods sold, so what got sold, but we also determine ending inventory for these 4 methods. So here's a problem. ABC Corporation reported the following March purchases and sales data for its only product. ABC uses a perpetual inventory system. Ending balances consist of 250 units. 100 came from the March 15th purchase, 100 from the March 29th purchase, and 50 from beginning inventory. Determine the cost assigned to ending inventory and cost of goods sold using A, the specific identification, B, the weighted average, C, FIFO, and D, LIFO. The first thing I want to say is that the second sentence here, ending inventory consists of 250 units, 100 from the March 15th purchase, 100 from the 29th, and 50 from beginning inventory. That sentence is only valid for specific identification. Okay, so that you're going to have homework sets that give you the same scenario, and you're only going to care about that second sentence if you're looking at specific identification. So under specific identification, we would know how much is in our ending inventory just by looking at, okay, 100 units came from the March 15th purchase. The March 15th purchase cost us $6. Okay, oops. The March 29th purchase, there was 100 units, and those units cost us $5. Okay, and under the beginning inventory, there was 50 units. Those 50 units cost $4 each. Okay, so our ending inventory we can compute just by saying 50 units were at $4, 100 units, and again this comes from here, the sentence, 100 units came from this middle tier of inventory, the March 15th purchase, and 100 units came from this last purchase on March 29th. Okay, we can go ahead and compute those out. 50 units at $4, 100 units at $5, 100 units at $6. That gives us our ending inventory. So we have 250 units in ending inventory, and cost of goods sold would be the items that were not sold. Or I'm sorry, were not in ending inventory. So these $4 units, 50 were in ending inventory. That means that 250 were sold. So 250 times 4 is 1,000. That middle tier, if 100 units were in ending inventory, that means that 250 units were sold. Okay, at $5 cost, that'd be $12.50. For this last tier, we had 100 units in ending inventory. That means that 50 units must have been sold. 50 times 6 equals 300. Add those up. Cost of goods sold totaled $2,550. Ending inventory again was $1,300. Okay, that's specific identification. They tell you specifically what units were left or what units got sold. Okay, we can check our figures by saying the units in ending inventory plus the units in cost of goods sold equals 800. Yep, that's how many units we had on hand. Okay, and we can do the same thing for the dollars. So 1,300 plus 2,550. Check that equals 3,850. If it does, then that's just one more little check to make sure we didn't make any errors. All right, under FIFO, this is a little bit harder. So I always recommend make a table. You have your date, your purchases, sales, and ending inventory columns. Okay, so purchases, sales, ending inventory. The beginning inventory, and I'm sorry, in this table, and it might just take you watching this a couple times to understand it, but in the table we're just going to track everything that happened throughout the entire month. So these 5 transactions we're going to track in the table. So on 3/1 we have beginning inventory, which became the ending inventory on 3/1, of 300 units at $4, okay, which equals $1,200. On March 10th we have a sale. Okay, the sale happened. We sold 150 units at $10, but watch out because this $10 is the selling price, and in this chapter we're not worried about the selling price, we're worried about our cost. Okay, so we have 150 units. The only inventory on hand as of March 10th is these units that cost $4. So 150 times $4, our cost of goods sold is $600. We have an ending inventory, 300 less 150 is 150 units times $4 is 600. Okay, again, it might take you watching this a couple times to understand. March 15th, we have another purchase, so we can log that in. 350 units at $5. Okay, so here's 315. We're going to log it into the purchases column. 350 times 5 is 1750. And then ending inventory, I always recommend go ahead and write both tiers. So you're going to carry down this ending inventory here and now add in our new tier of inventory. So 150 units times $4, 350 units times $5. Okay, students often want to shortcut this, and maybe you can after you have done it a few times, but I always recommend start with the way that I'm teaching you. Okay, if you can figure out a better way later, go ahead and do a better way, but follow along, take the extra steps it takes to rewrite these tiers of inventory, okay, because those are the students that get it. The students that try to shortcut are the students that struggle through this chapter. Okay, the next item on the 23rd, we have a sale. It's 400 units at $10. But remember, we're going to ignore the retail cost or retail price. We don't care about the selling price. So here we have 400 units. Now if you look down here at our inventory, we have two different tiers of inventory. 150 units at $4 and 350 at $5. So now it's like looking at the gallons of milk. Which tier are we going to sell? Okay, we have to look at our assumption. We're using FIFO, first in, first out. Okay. So whenever you do first in, first out, just draw an arrow down. Okay, because you're going to take from this first tier first. So first in is the first out. So now you're going to take 150 units, that whole first tier, plus you need 400 units. So you want to take 400 less 150 is 250 units. So take 250 units from that second tier at $5. That's what you're going to sell. And then over in this ending inventory, go ahead and write your remaining inventory. So 350 less 250 is 100 units. Okay, let me back that up and show it to you again. Okay, we've got two tiers of inventory. The question is, it's like looking at the gallons of milk. Which one do I pull from? I'm going to sell 400 units. Under FIFO, I take from the top down. First in is the first out. So I'm going to pull all 150 units, but I still need 250 units to make the 400 I sold. So 250 units come from the second tier at $5, which leaves me with 100 remaining units from this tier. Okay, and then March 29th, I have a purchase of 150 units, so I'm going to log that in. So 150 at 6, and then again, carry down this original inventory, add in your new one, 150 at 6. Okay, and now we're done with the 5 transactions, so now we can calculate our totals. Okay, for cost of goods sold, cost of goods sold, you want to just add up this whole middle column. Okay, so it's 550 units. The total dollars is 600 plus 600 plus 1250, which gives you 2450. For ending inventory, we just take this last bucket here. So it's 250 units. The total dollars is 1400. And again, you can confirm your numbers by taking your total sales. So 550 units were sold. 250 units are in ending inventory. That totals 800 up here. Dollars 2450 plus 1400 should equal our total units available, 3850. Okay. Under LIFO, we're going to go through these same 5 transactions. The only thing is that when we have 2 tiers, we're going to pick from the bottom up. Okay, so beginning inventory, it's same 300 units at $4. Okay, our first sale is 150 units. We don't care about the selling price. What we care about is this $4 cost. So 150 units times $4. Okay, we only have one tier, so there's no question. Remaining inventory is 300 less 150, so it's 150 units at $6. On the 15th, we purchased some more units, so 350 at $5. And I'm going to carry down my old inventory, put that in the bucket here, and add in my new one that I just purchased. Okay, that simple action of rewriting makes it easier to figure out what my next sale is. So here I'm going to go ahead on the 23rd, I'm going to sell 400 units. Okay, remember that we don't care about that retail price. So what units do I pick from? Okay, if it's last in, first out, you want to pull from the bottom up. The last tier in is the first tier out. So I'm going to take, I want to sell 400 units and I want to determine the cost. So 350 units, all this 350 units at $5 will be pulled. 50 units from this top tier. Okay, my last in is my first out, and then I go up. So 50 units at 4, and then I want to write in my remaining inventory. So of this 150 units, I sold 50, so I'm left with 100 units at $4. Okay, on the 29th, I make another purchase. I plug that in. And again, 2 tiers of inventory. I write my old inventory balance plus add in my new. If I were to sell again, let's say I were to sell 100 units, it would come from this bottom tier. Last in, first out. Okay, I can go ahead and calculate my totals now. Cost of goods sold, I've got 550 units. My total dollars is $25.50. Ending inventory is just this last bucket, 250 units at $1,300. Okay, I can check my totals. 550 plus 250 is 800. 2550 plus 1,300 is 3850. Okay. All right, weighted average. Going to go through these same 5 transactions again. Here we go, beginning inventory. 3-1, I've got 300 units at $4 in my ending inventory. I've got a sale. The sale doesn't change because I only have one tier of inventory. So 150 units get sold. Remember to ignore the retail price of $10. 150 times 4 is 600. My remaining inventory is 150 at 4. Okay. On the 15th, I'm going to purchase 350 units at $5. Here's where you're going to see the weighted average come into play. In this ending inventory column, I'm going to write my old inventory plus my new inventory. Then remember weighted average from the gallons of milk? I want to add up my dollars and add up my units. So my total dollars are $23.50. My total units are 500. I take total dollars divided by total units and get an average cost, weighted average cost of $4.70. See how it's a little closer to the $5, and that's because it's weighted. Okay, so you cannot just take 4 plus 5 divided by 2. That's not a weighted average. Weighted average, we multiply across and take total dollars by total units, and you can see it's more heavily weighted towards the $5 unit. All right, now when I sell, I'm going to sell 400 units, forget about the retail price. I can write 400 units times 470, my weighted average. Okay, and then I have 100 units left at 470. Okay, my last purchase would be 150 units at $6. Again, I'm going to take my old inventory, carry it down, add in my new inventory, and I can go ahead and calculate my total cost of goods sold. 550 units at $24.80. 250 units are an ending inventory at $13.70. If I added these two up, I should come to $38.50. If I wanted to do one more sale, I would go ahead and weight this last column. So 470 plus 900 is 1370, divided by units, 250. My new weighted average per unit would be 548. So the next sale would be at $5.48. Okay. All right, so those are the 4 methods for a perpetual system. I'm going to take you through lower of cost and market, and then I'm also going to take you back through the periodic method for these 4 different systems. So lower of cost or market. Basically what this is it's a calculation to see, accounting is very conservative. So we never overvalue our inventory, but if for some reason, let's say that we're a technology business, and all of a sudden we come up with a new technology and the price of our existing inventory crashes, we want to go ahead and compute lower of cost or market to make sure that we don't need to write down our inventory. So writing down our inventory would be to either the lower of cost or market. Now the thing about market is it's not the selling price. The thing about market is that it's basically replacement cost. Okay, so the first step I always tell students is just to determine the totals. So go ahead and compute 15 units times 5 and 15 units times 7. Okay, so you would go through that whole process. 35 units times 12, 35 units times 10. 28 times 8 is 224. 28 times 6 is 168. 17 times 4 is 68. 17 times 6 is 102. Okay, if we want to figure out lower of cost or market as a whole, all you do is you compare your totals. 787 for total cost and 725 for market. Which one's lower? Market is. We would write down the inventory from 787, what it's in our books right now, we would write it down to 725. Okay, you guys don't need to worry about the actual journal entry, you just need to understand how to do this, how to do the computation here. So if we were applying this as a whole, the inventory would be written down to 725. If we applied it separately to each product, basically you go through the same computation, but this time we're going to go ahead and just figure out which is the lower in each category. So for product A, cost is the lower one. For product B, market is lower. For product C, market is lower, and for our product D, cost is lower. Then you add those four up, so 75 plus 350 plus 168 plus 68 gives you 661. In this case, we would go ahead and write down our inventory to $661. Okay, that's a pretty easy concept. If you need to pause and re-listen, that's basically all it is, as you're just computing it either in total, 787 versus 725, or you just go product by product and look for the lower. All right, last thing that we're going to do is look at periodic, these four methods: specific identification, FIFO, LIFO, and weighted average. And under the periodic method, it's a little easier. We don't need the table, so I always tell students, if you see that it's a perpetual method, use the T for perpetual, or the T that's in perpetual, and know that you want to make a table. If there's no T, like periodic, there's no table that you need to create. So remember, just a refresher, that under the periodic method, purchases are always recorded, the sale is always recorded, but the reduction of inventory and recording of cost of goods sold, the expense, are only done periodically. So looking at the same problem under a periodic method, if we did specific identification, nothing changes. Okay, it's still the same 100 units are an ending inventory from the March 29th purchase. Okay, it's still the same 100 from the 29th. I'm sorry, 100 units from the March 15th and 50 units from the March 1st. Okay, so nothing has changed here. We could go ahead and compute ending inventory. It would be the same. Cost of goods sold would be the same. They're telling us ending inventory consists of 250 units. 100 of those are from the March 15th purchase, which is down here. 100 units at $5. 100 are from the 29th, 100 at $6, and 50 are from the beginning inventory, so 50 at $4. Okay, so ending inventory would be 1,300. Cost of goods sold is essentially what didn't stick in ending inventory. So 50 units are left from the beginning inventory, then 250 got sold at $4. If 100 got sold from the $5 tier, if 100 got sold from the $5 tier, then 250, let me repeat that. If 100 were left in ending inventory from the $5 tier, 250 must have been sold from the $5 tier. If 100 from the $6 tier were left in ending inventory, then clearly 50 were sold from the $6 tier. Okay, so this is exactly the same as the perpetual method, because we can identify specifically what units got sold and which units are in ending inventory. Okay, again, you could check your figures, make sure everything works out. Under periodic, it's a little different. We don't need a table for FIFO. What happens is we just identify, here's our inventory, our beginning inventory purchase plus our purchases. You apply that same first in as the first out. So if we sold 550 units, see over here, you just pull from the top down. So 300 got sold, and then in order to equal 550, 250 units must have gotten sold from the middle tier. So you're just pulling from the top down. It's like you're pulling all 300 units off the top, and to get to 550, remember 550 is over here, to get to 250 more units to pull down, you pull from the second tier. So 300 times 4 is 1,200, 250 times 5 is 1,250, cost of goods sold is 2,450. Ending inventory would be the remaining 100 from this middle tier and all 150 from the bottom tier. That's periodic. You just look at all the inventory that you had through the whole period. Okay, you don't do it on a day-by-day basis. Okay, you just look at what did you have on hand. Here's the units sold. Go ahead and pull out cost of goods sold is from the top down. Okay. Under LIFO, we're going to do the same thing. Just look at what are the units on hand. The only thing is now we're going to pull from the bottom up. Last in is first out. So when we're computing cost of goods sold, it's from the bottom. We sold 550 units. So you take all 150 from the bottom tier. Last in is the first out. All 350 units from the $5 tier. and we still need 50 more units. So then you take 50 from beginning inventory. So 50 times 4. Okay, there's your cost of goods sold. Ending inventory is what's left. We sold everything but 250 units from the top tier. So 250 units times 4 would be 1,000. Okay, under weighted average. Again, this is simple. You don't have to worry about when the sales occurred. You just take total dollars. So 3850 is your total inventory that you had on hand during the month, divided by total units to get a total dollar amount. Cost of goods sold is that same 550 times your average equals 2645.50 to get ending inventory. So what's left? You had 800 units, you sold 550. That means ending inventory must be 250 units times $4.81. Your ending inventory is $1,202.50. Okay,